Dolphin Learning.
Hi, welcome back to Dolphin Learning. Today we'll be covering the weighted average cost of capital, also known as WACC. I'll give you a brief overview of what WACC is and the components that make up of it, including the cost of debt and the cost of equity. So without any further ado, let's get started. Okay, so what is WACC? WACC is the average cost of capital that a company is expected to pay its investors to finance its assets, right? So what are its sources of capital? Well, there are three main sources of capital when it comes to financing. There is debt, preferred shares, and equity. With debt, you'd either do it through a bank loan or you'd do it through an issue of bonds. With equity, you'd raise the capital by giving a portion of your company in the form of common shares. Similarly, in preferred shares, which is also a form of equity, what you would do is you'd also give out some preferred shares to raise that capital. Now that we've understood how the capital is raised, where does the cost come from? Well, the cost associated with the capital is the cost that we have to pay to each of these investors or lenders if it's a bank. But with debt, the cost is the interest that has to be paid. With equity, the cost is the dividend that has to be paid to the common shares. And with preferred shares, the cost is the fixed dividend that has to be paid with the preferred shares. Now note that there's a difference between the fixed dividend and the dividend in common shares. Because with fixed dividend in preferred shares, you pay out a certain percentage or a certain dollar figure to the preferred shareholders, whereas common shareholders don't receive that benefit. If the company makes a profit, they might receive a dividend. If the company is not making any profit, they're not going to receive any dividends. Whereas preferred shares and debt holders, regardless of the situation, they are to be paid in general. Now, what we're calculating is the weighted average cost, right? So how do we get the weight? We get the weight by looking at the debt, the preferred share, and equity, the value of each one of those, and multiplying it by the cost of each sources of financing, including interest, fixed dividend, and dividend. Fixed dividend for preferred shares, dividend for equity. Now that we've understood how the sources of financing and the cost of capital works out to be, what it works out to be, let's go ahead and look at the weighted average cost of capital formula. Okay, so now that we know what the sources of capital are and the cost associated with each one of them, let's go ahead and use this information and generate a WACC equation. So we'll start off by calculating the total value of debt. And to do that, what we'll do is take the number of bonds outstanding and multiply it with the market value of the bond. And that will give us the total value of debt. Similarly, with equity, we've issued common shares. So we'll take number of common shares outstanding and multiply it with the market value of each common shares, giving us the total value of equity. Lastly, if there are any preferred shares in that organization or the company, we'll take the number of preferred shares outstanding and multiply it with the market value per preferred share or for that share or for that preferred share. Anyways, but we'll get the total value of preferred share for that. Now we take the total value of debt, the total value of preferred shares, and the total value of equity. And if we put all that together, we'll get the total value of the company. Now, this information is important because now that we've calculated the value of the company, we need to determine what percentage of total debt makes up the value of the company, what percentage of preferred shares make up the total value of the company, and what percentage of total equity make up the total value of the company. So to do that, I'm just going to simply label each one of these components or each one of these capital sources with their respective titles. So I'm just going to leave this at D for total value of debt, move this to P for preferred shares or total value of preferred shares, and E for total value of equity, and V for the value of the company. The reason I'm doing this is so that it's more simpler for you to understand. Now, in order to calculate the weighted debt or the percentage of debt in that company, is simply taking the total value of debt and dividing it by the total value of the company. The exact same way we can do it with equity, where we take the total value of equity and divide it by the total value of the company. Lastly, with preferred shares, we take the total value of preferred shares, right here that we were calculating, and then we divide it by the total value of the company. And all this information will give us a percentage of debt that the company has, percentage of preferred share in terms of weight that the company has, and percentage of equity or common shares that the company has issued, right? Now that we've calculated the sources of financing, let's see what makes up the cost of those financing. And there are three costs, right? There's cost of debt associated with cost of debt, cost of preferred share associated with cost of preferred share, cost of equity associated with cost of equity, right? Okay, so in order to calculate the cost of debt, you can simply use the time value of money, where if it's not given to you, if a percentage of number is not given, that X amount of interest has to be paid to the debt holder or to the bond holder, then you can simply use the time value of money functions to calculate a percentage. And how do we do that? We already have the information given to us, right? Where we will have the present value of the bond, right? Whatever the market value is. We'll have the future value. Typically, it's $1,000. We have the number of coupon payments remaining will be given to you if the fixed percentage is not given. And we'll have the payment in terms of coupon payments, or what percentage of payments are to be made, if it's annually, semi-annually, whatever the situation is. With this information, you'll be able to get the I per Y for the cost of debt, right? If the cost of debt is not given, you could use the time value of money. Again, I'm just repeating myself, but you could use the time value of money to generate this I per Y. And once you have this, what we'll have to do is think about it and know that debt is tax deductible. So that's why you also have to remember that whatever information that you get here, you have to take out 1 minus the tax rate. So whatever the tax rate is, you subtract, because debt is tax deductible. So you have to remove the tax component from that debt calculation. Now let's go ahead and look at equity section, or the cost of equity. And to do that, in order to calculate that, there's two ways. The first way is to use the dividend discount model, depending on what they have given you in the question. But the dividend discount model, which is generally, you have a price, which is PO. You have a D1, which is the expected dividend that you are to be received, with the expected return that you have in mind, subtracted by the growth rate of the company. Now, you obviously have the PO because you have the market value of the common shares. You'll be given information to calculate the D1. You'd be either given the calculation to calculate the growth rate as well. So what we need to calculate is the KE, or the cost of equity, and we just need to rearrange the equation so that KE is equal to D1 divided by the price of the common shares plus the growth rate, and this will give us the cost of equity. The other way to calculate it is with capital asset pricing model, also known as CAPM. So sometimes you're given information relating to the price of the bond and the growth rate and the dividends. Sometimes you're just given, like, there's a T-bill, which is risk-free rate, and then a beta, and then the market risk premium, where market risk minus risk-free rate, which is this whole bracket, is equal to market risk premium. We'll be given that information in the question, but it could be either or. but you'd use that information to calculate the cost of equity. Lastly, in order to calculate the cost of preferred shares, which is also a form of equity, what we can do is take the price of the preferred shares, right, market value of the preferred shares, and there's no D1, you see, there's no D1 here because the preferred shares have fixed dividend. So that's why there's no D1. So you take the dividend that our preferred shares are to be paid and divide it by the KP. But in this sense, or in this situation, we don't have the KP. We're looking to calculate the KP. So what we'll need to do is just rearrange it so that KP, or the cost of preferred shares, is equal to dividend divided by price for that preferred share. And we'll get the percentage. Now that we have all this information, we can use this information and generate the WACC equation. Let's see how that's made up of. So we calculated the WD, which was total value of debt divided by the total value of the company. So we got that WD there. Multiply that with the cost of debt. If it's given, great. If not, use the time value of money. And that makes up the component for debt. Now, don't forget that debt is tax deductible. So you have to take the percentage, 1 minus the tax rate, and that will give you the whole function for debt. Now, with equity, what we have is WE. Also, we calculated that with total value of equity divided by total value of debt. And we took the CAPM model or the DDM model, dividend discount model, to calculate the cost of equity depending on which information was given to you, and calculated the cost of equity. And we came up with this information. So then we're just multiplying the two together. Similarly, same thing here. Lastly, we're just taking the cost of preferred shares, right, and multiplying that with the weight percentage of the preferred share, allowing us to generate a full WACC equation. Now, sometimes there is no preferred share in that equation, right? Or there's no preferred share given in the question. Then what do we do in that sense? Then we simply just ignore this piece of equation and we just simply calculate this part of the equation plus the cost of equity. And that's how the WACC formula is generated. Now let's go ahead and look at why WACC is important. So why is WACC important, right? Well, one of the main purposes of calculating WACC is to determine the average cost of capital that a company will require to finance its assets. So what does this mean? So let's say that there was a factory, a new plant that a company was making, and you had to determine if that project is feasible or not with the current options of financing with debt, equity, and preferred shares, right? You had to decide whether if we should invest in that factory or not. How do we do that, right? We calculate, one of the ways we calculate is, in terms of finance, is to determine the WACC for that situation. You'll be given the information to calculate, but you determine the WACC for that calculation. And once you have the WACC, you can use the WACC to see if it generates a positive net present value or a negative net present value. If it generates a positive net present value with that WACC and all the other information, including present value, future value, time, interest rate is going to be WACC, but with that information, you'd go ahead with that project. But if it generates anything below zero, that project is not feasible. Similarly, you can also use the internal rate of return and compare it with WACC and see if it is higher or lower than WACC. If it's higher than WACC, it's a yes and you do the project. If it's lower than WACC, it's a no and you wouldn't do the project. So that's all I had for this video of weighted average cost of capital. I hope you enjoyed it. If you did, please give it a thumbs up and comment down if you have any questions. And I would really appreciate if you subscribe to the channel. Thank you.